economy crashed. I can't predict that. I can't predict the weather.
I can. I'm a Doppler fucking radar. You took something and you didn't give it back. Then banks screwed you over. Take your pick. Either way, you lost. But I made more money during the crash than before it. You can too. You just gotta stop lying to yourself and ask, what did you do wrong that your family lives in a motel?
Yippee-ki-yay, YouTube. It's Brendan from Market Makers, your home for tomorrow's TA today. Often imitate it, never replicate it. Welcome to the show, everybody. Smash the like button, hit the subscribe button if you enjoy this content. We top tick the market, 49.22. You guys had this target for weeks. The market fell 1.85%. That one drop, that 1 day drop wiped out over a week's worth of gains in the S&P. And this is how it works, guys. Remember, February, we're looking for our sell-off, our retracement of 10%. I'll show you guys in the charts. That 10% retracement, the same on average we did in February 23, same on average we did in February 22, and the same on average we did in February of 2000, our Y2K fractal pattern. Now, the market's rebounding a little bit today because we had the drop. You're getting some buying, but on deck, we have Apple, Meta, and Amazon tonight. Will we see a repeat of what happened with Google and Microsoft? Are we going to see one, two, all of them fail? Or will we see a mixed bag? If we get stronger earnings, guys, and the market likes what they have to say, we could be retesting the highs. We're going to look at it in the charts. If not, we're going to continue with a descent and make a lower high. Time is more important than price. February, I still believe, is going to be the sell-off month, and that's when the media will come back out and tell you to buy. The generational buying opportunity, everything you could have dreamed about is at a discount. MPCs, lemmings, everybody's going to buy. Then we're going to track back to our all-time high in March and April, make a new all-time high before we sell off into the summer and the fall. And Fed Chair Powell actually just gave us further confluence for this pattern to play out because he pretty much squashed the March rate hike, which the market had priced in at 50%. Now, if my TA plays out, guys, as it's been playing out, if it continues to play out, they would have no reason to be cutting, because if we do sell off in February, this 9-10% correction, then push back up to a new all-time high, why are they cutting rates? So it makes sense. So I don't think you'll get that first rate cut until the summer as the market is really breaking down. Now, CNBC brought on Jeff Gundlach after Fed Chair Powell spoke. Jeff Gundlach, for those of you that don't know, has DoubleLine. That's his company, billionaire bond investor, billionaire investor. And he said he's still predicting recession, which triggered some people on CNBC. And he said he likes cash and short-term treasuries, and his favorite market to invest in after a pullback, after cheaper prices with the recession, was his caveat, is India. That was his number one target because he likes the economy there. So then they bring on Josh Brown, who's a regular on CNBC, to give a rebuttal of sorts. I want to play this clip, and we'll talk about this clip here on the other side. Warlock, clip.
Joining me now, Post 9, Ritholtz Wealth Management's Josh Brown. We'll get a quick comment from you before we broaden it out after a break. All right, what do we do?
Well, look, I think Jeff came on in November and he was enthusiastic. And the only thing that's really changed from then until now is we had one of the best 3-month periods in the history of the stock market. We did plus 19%. And quite frankly, we've done that less than 20 times over the last 100 years. The problem for the recession case is that on 16 of those 17 occasions, not only did you not have stocks lower, but you had no recession. And in fact, the market was up an average of over 30% 1 year later. So I would have to hear the case for why this time would be different. If you think we had this $5 trillion rally in the stock market over the course of 90 days over absolutely nothing, that's a really interesting story, because that says to me everyone's wrong and the last people still calling for a recession are right. They might be, but there's very little evidence. Everyone is working. People's bills are being paid. The market seems fine. The economy seems fine. It certainly could change. And I think if we were going to interest rates of 6% to fight inflation, everyone would be singing a different tune. That's not what we're talking about. We're talking about the first cut moving from March to May. To me, it's a very big, no big deal.
Yeah.
What you just said is one of the most insanely idiotic things I have ever heard. At no point in your rambling, incoherent response were you even close to anything that could be considered a rational thought. Everyone in this room is now dumber for having listened to it.
And now for something completely different.
All right, so a couple of things Josh said, and this is really key. Josh said for the few, notice he said, for the few people still calling for a recession to be right, he needs to see the case made because the economy's strong and everybody is working. Well, let's deal with the employment factor first. Lee, unemployment chart. Give me the red lines for the recession. Guys, notice the unemployment chart. Wall Street has this backwards. High unemployment doesn't come before a recession. The red lines are your recession. Look at the black wave. That's unemployment. Unemployment spikes during and after the recession. A couple of key things Josh left out in his rebuttal. The LEI. He's previously said he doesn't care about the LEI, the leading economic indicators. Why you and I care about the LEI? Zero false signals, predicted every single recession the last 50 years. That's why I care, and we are in recession territory. And of course, he left out the yield curve inversion. 3-month, 10-year, zero false signals, predicted every single recession the last 55 years. Every single recession. So you can, as an analyst, and you see these articles all the time on Market Watch, you'll see them on CNBC, you'll see them on Bloomberg, you'll see people like this repeat certain data points. Whenever the market goes up X, typically 90% of the time, 99% of the time, 80% of the time, it goes up X the following year. You have to understand the cycle. We have been in the longest and strongest bull run in stock market history, 40-year bull market, okay? So on a Pareto distribution, 80% of the time, we go up regardless of the year. 80% of the time. 20% of the time, we go down. But what happened prior to the longest and strongest bull market in stock market history? 1929 peak, what happened? No new highs until the 1950s, okay? We had the Nifty 50 in 1970, early 1970s. The Dow made its high, I believe, 1969. No new high until 1980. So when you extrapolate data points from the longest bull market in stock market history, of course that looks rosy, but you have to frame the context of the economy, the context of the signals you are getting that have zero false signals, 100% hit rate. Those, I think, kind of important, guys. Kind of important that they predicted every recession with zero false signals. So understand Wall Street's all on the same side of the trade. They're all on the same side of the trade. And you guys know, premise of this show, it's a Ponzi market. These are sales reps. They make no money by you being in cash. They make money by charging you fees to manage your money, meaning you have to stay invested. And they give you sales pitches and slogans. You hear them all the time. The way to make money, Bob, is to stay invested in the market no matter what. Not true at all if you look at the cycles, the years that can go by. After the dot-com crash, 7 years for a marginal high, 7 years to make back that money that you lost. And individual equities, of course, went down much longer, much stronger than that, okay? These wide swaths of time can pass when you have these parabolic bubbles, which thank God are rare. But they come up with these slogans that keep you invested at all costs, which is why I believe he's speaking for Wall Street in a literal sense, because this is why I think new all-time highs are still to come after this retracement. They really do believe, or at least they want you to believe, that this is a super strong economy, ignoring all the indications, super strong economy where everybody's working. When we have this sell-off, this pullback, guys, we're going to have that big rush of dumb money, big rush of big dumb money right back into the market and push it right back up. This is going to be a fantastic trading opportunity. And just remember, Powell illustrated this in his response. I mean, I had a laugh when I heard this. So one of the questions to Powell, I watched the press conference. One of the questions was, well, what if inflation stays below 2%? And Powell, Powell is, We have ways to deal with that. I'm paraphrasing. Just think about that. They don't want inflation to ever be below 2%. Again, remember, this 2% target has only existed since 2012 with Ben Bernanke. It allows the government to have deficits, to spend money they don't have, because the Fed, who they appoint, remember, they appoint these people to the governorship, to the head of the Fed. They appoint these people, can therefore print more money, monetize debt, and now we have $8 trillion on the Fed's balance sheet, right? And we have $34 trillion in deficits in the country. So they always need inflation, because what is inflation? The old Webster dictionary is inflation is inflating the money supply. The government, Biden, Powell, the Fed, the media would like you to believe inflation is the price going up and up and up, regardless of the asset, whether it's food, whether it's cars. That's inflation. Prices are up because of inflation. No, prices are up because you inflated the money supply, driving prices up. Driving the prices up. They don't understand how inflation's created. And I don't know if it's pure ignorance or if it's willful, right? Because it's created a house of cards that we live in now. You guys know on Trueflation, we have our purchasing power down 22%. That means, look at the inverse of that, everything costs on average 22% more. And this kills people. And Powell acknowledged that people are sick and tired of paying higher prices, but he doesn't want any deflation, meaning there's no driver for prices to come down, only go up. If they get to their 2%, that's 2% on top of the inflation that you already have. And that's what people need to understand. It's absolutely crazy. And this is why you have this interesting dichotomy that happened with Bush. President Bush, during his term, had the highest approval rating after 9/11, and then the lowest approval rating in the GFC, right? Obviously, economy collapse. It's the economy, stupid. Look at Biden. Currently, the lowest approval rating at this point in his term in U.S. history. And they can't get their head around that on Bloomberg or on CNBC. Why is there such a great disconnect with the American public when the economy's strong? Everybody's working. Everybody has a job. Wages are up because everything disproportionately cost more. Remember, the government, the Fed will always move to protect the wealthiest people in the country. The top 10% own 93% of the stocks, and that is heavily skewed to the top 1%. So remember, they will always move to protect the elite, protect the wealthy, which is why when we have the market start to plunge, I believe this summer, you're going to see the Fed step in, cut rates dramatically. Don't let inflation go down too low. Don't want deflation. We don't want anything to cost less. And then you will try to protect the market to protect the wealth of the wealthiest people in the country. These are the power brokers, the elites that tell you how to live, tell you what to drive, want to tell you what you should eat. Meanwhile, they can do whatever the hell they want because that's how we are set up as a country.
America doesn't bail out the losers. America was built by bailing out winners, by rigging a nation of the winners, for the winners, by the winners.
Just remember in the GFC, I was at Merrill Lynch. And at Merrill Lynch, we were days away from failure. Our CEO still got his multi-million-dollar parachute. Most of the CEOs, I believe, if not all of them, got their multi-million-dollar parachutes. Us, the taxpayer, Gen X, the boomers, we bailed out Wall Street. That was our money. None of them went to jail. They all made tens of millions of dollars, and they're doing the same thing again. And you're going to see your government and your Fed move against the American people again to bail them out when the time comes. All right, guys, let's go ahead and start the show and get into some charts. All right, guys, if you want to trade these markets, be sure to check out our two fantastic sponsors, SimpleFX and BingX. On Simple, with our link, get up to a $5,000 first-time deposit bonus. Trade all the global equities, commodities, Bitcoin, all in one great app. And you can check out BingX for the myriad of cryptos. All at Intel is pasted in the YouTube comments as well as the video description with Lee's Telegram. If you guys want to join our room, Both those sponsors will pay for your first month on our Discord. Message Lee with any questions at all. Let's jump into the S&P, guys. So looking at the S&P, let's rewind the clock back to when I just got out of high school a couple of years earlier, 1999. So 99, guys, our fractal pattern. July of 99, make a high. We sell off 13%, October low. So July high, October low. We wave up into when? We wave up into January, a 20% move up. And here we are in February looking for the same 10% correction we had in .com. And then look at this, a nice 17% rocket ship to make a new all-time high before the market sold off. So again, July high, October low, January top, February low, late March, March 24th. So March, April, new all-time high. Go to our current market, exact same fractal pattern. July high, October low, rally up, topping here in January, looking for our February sell-off of, again, 10%, the same 10% in Y2K in 2022 and 2023, expecting it in 2024. That looks like around 4,400 here at the 618, 4,420. I'm going to show you this in the TA, the higher level target as well, okay? And then that wave up rocket ship, new all-time high, 5234. So we'll call it 5,200 to 5,250. Let's look at the S&P. Again, we hit our target 49.22. This is on the 3-day chart. And you can see price is waving back up again today because we have more big tech. Can Meta, can Apple, can Amazon save the market? Remember, all of the money flows into those 7 stocks. They are responsible, just 3 stocks responsible for 81% of the gains this year. Whereas the RSP, the equal weight, has done nothing. It's flat. So can big tech save the day, or are we going to continue here at the very beginning of our February sell-off coming down 10%? Let's look at those targets again. So we'll go ahead and pull this here from that October low, guys. We're going to pull our targets here on the S&P to our current high that we have. We have the 382 at 46.15. This is my higher level target. You tick it right here at the top of this pivot. You see that? So at a minimum, I'm looking for this 300 plus bar retracement. So whether we come down, come up, do something like this little dance here in February, at a minimum, I'm looking for that 300 bar retracement. And I think if we break that, I think we're coming down to 44.20 at the 618. Again, the most commonly retraced to fib, which would be a 500 bar retracement. So we're looking for this move. And remember, these moves happen fast. The sell-off yesterday of 1.85% wiped out over a week's worth of gains. Remember, when the market falls, everybody rushes at the same time. The market falls 3 to 5 times faster than it rises. So we're going to look for 4,600 or 4,400 here throughout February. Let's get through today, get through this week, and I think we're going to see a lot of red days ahead here in February. Let's go ahead and move over to Bitcoin. What does this mean for Bitcoin? On the 3-day chart, guys, we got up to the 50% retracement, 43,762. It's struggling mightily there. The targets I like, again, we shorted this up here at the 618. These are targets that I shared over and over again on YouTube now for weeks. The 618 from the all-time high. We shorted it up here, got a 20% drop, but if we're going to look for a rebound short here, I like 46,750. 44 or 45K is okay, the 618, but I like to see Bitcoin really come up and give us some wicks, but I want to see this confluence with the other markets. Remember, big tech earnings are, let's just say they're astounding or the market really loves them. You could be retesting the highs in the S&P, right? You could be going up to 49.50. Time is more important than price, but you could be moving up. So I want to see what Bitcoin does in confluence with the broader marketplace. But the targets for the downside, guys, we've been talking about these the last few videos. You see them on the thumbnail. Again, all we have to do here, pull our breakout or pull our low here from the diamond pattern. And we look at this, and Bitcoin found support right at 39,520 at the 382. I'm looking at Bitcoin at a minimum coming down to the 618, 33,672. And or the 786.29.5. Okay, those are my two Bitcoin targets. So if the S&P goes to 4,600 and that's the retracement, that 300 plus bar retracement, I'm looking at Bitcoin at 33.6. If the S&P goes to 4,400, I'm looking at Bitcoin at 29.5. But remember, the overall trajectory of this move, if we pull a fib and we take it here from our high, and let's go down to 29.5, that March, April high, we're looking for the new all-time high in the markets, I think is going to give you the 1618 at 58.5. 58.5, and I pulled this fib down to the 786, you're going to get 60K. So you're looking at 58 to 60K Bitcoin. At the 786 here, you're getting 61K. So 58 to 61K, late March, early April high. I know you have the halving, you have other events, but again, remember my thesis, your thesis may be different. The Bitcoin's going to move with the markets, and when trillions fall out of the markets, Bitcoin's going to fall with the markets. That's a huge move. Let's look at this in percentage gain. So if you top tick this year, if you held your short and everything plays out, right? Everything, of course, would have to play out for this to be true, but you're looking at a 31% drawdown to 33.6, and you're looking at a 40% drawdown to the 786 at 29.5. So let's look at this from the upside. If we get to 33.6 here at this 618, and we come up to our target of 58.5, I believe it was, right around 75% gain. 75% gain. And so that means it's even more of a gain when you come down to the 29.5 target, 100% gain. 100%. That's why people that like this channel really like this channel, because we captured huge moves. We've been on a hot streak with Bitcoin lately. October 23rd, our 50% long trade, shared that on YouTube, talked about the option, the short up here at the 618 for weeks, hit it, 20% drop, and now you're just floating. So that's Bitcoin, guys, in a nutshell. Let's look at this. Oh, we already did that projection. So let's go ahead and jump over to Dow. Dow is at 38.4 right now. This is the cash index, guys. So this is the Dow price I'm looking at. Let's look at this here. Dow, if we pull up this retracement, is that our October? That's our October low. So we're looking at the Dow for downside targets. If we're topping out here, this is a 3-day chart, guys. If we're topping out here on the Dow, looking at the downside targets, again, you got to break 36,199. If you break 36,199, this will be in confluence with the S&P, obviously, right? If the S&P breaks 46 and moves to 44, the Dow's coming to 34,710. Big drawdowns, and this is all going to happen in February. Maybe it goes into the first week of March. Maybe everything gets moved out a week, guys. Time is more important than price. We're following these fractal movements with price, and so far everything is playing out to a T. So this is fantastic. But these are the moves I'm looking at here for the Dow, guys. So remember, we got these levels here on the Dow. Looking at our upside projections. Got above your 1618 at 37.8. You had a lot of turbulence, a lot of volatility here. Here's your spike up. Going to see it start to move back down. I think we're going to start seeing these markets break down here into February once we get past their earnings. Bounce over to big tech, NASDAQ 100. Looking at the NASDAQ, 17,238. Looks like to me, you have your topping process. You have a 3 waves to a top pattern that formed. Wave 1. Wave 2, here's your wave 3. And now we're looking at the NASDAQ to potentially make a lower high here and start breaking down. This is going to heavily depend on these 3 big tech earnings today as well, right? But if we pull this is a daily chart, we pull this from the top here to the base. You're looking at, if the NASDAQ got more bullish, let's say the big tech earnings are good, 17.5, 17.6. Watch that range right there, 17.5, 17.6. You're at 17,238 here. Watch that range and see if that holds for your high, and you start to roll over and start to break down. But NASDAQ still looks really weak, 17,236. Even after this sell-off, you're holding just above the 1618 at 17.1. So you're using that essentially for support. You can see you hit it right there. Let's go ahead and look at the Russell. People have been requesting this. This is the E-mini Russell, guys. E-mini Russell. This is a US 2000 on SimpleFX. So let's look at this. We have the Russell. We have it bounce back up. And what did it hit? The 618 at 2023 to the dollar. Look at that. 2023 here on the 3-day chart rolled back down. Remember, the Russell's high beta. The Russell leads the market. In 2021, in your big bull run up, the Russell topped out first in November of 2021, followed a couple weeks later by the NASDAQ. The Russell and Bitcoin, both high beta, topped out within 72 hours of each other. That was their all-time highs. And the Russell is still 20% down from its all-time high. Now, when you see that divergence, this is a clear indicator of the health of the quote-unquote bull run. You're off your all-time high by 20% while 7 stocks led the major indices to new all-time highs. You don't have confluence for it, and you have the incoming recession. Important things to note. So the Russell already looks like it's making its double top, as you can see. And when it moves to breakdown, you're going to see everything start breaking down as well. And if we look at the neckline here, the fractal has to take out 1904. Russell's at 1975. Could get more volatility here. Again, we got to get through earnings, get more volatility here, and we'll see when this starts breaking down and rolling over. But you can see the wicks here. 2023 is a strong level of support, or resistance, I should say, right at the 618. I guess you probably want to see some downside targets for the Russell. Let's go ahead and do that real quick. Looking at the Russell, we're looking at 618 is at 1813, bringing you back here. You're at 1973. But remember, the Russell has displayed a lot more weakness. So I think you'd easily see these targets of 1813 with the major indices, especially if they move to their targets as well. The DAX, this is DE40 on Simple, guys. This is DE40 on Simple. So I have the futures up here for the DAX, 16,982. Again, the European markets just are harmonically target 16,983 to 16,900. You finally got above it, but you're still below the 17,223. I would watch this in confluence with the U.S. markets because you're printing a very nice 3-wave top pattern right here. So you can see this below 16,868. If you find that as resistance, that means price came down, back tested this area, and starts to break down. But I would trade all of the European markets in confluence with the U.S. markets. I like this range for resistance. I like the DAX up here where it is, but I'm only going to be playing the markets with 1 or 2 assets at a time. So we'll see. If we come up to test 17,223 and a little bit more of a rebound, I like that level a lot. That's where we wicked or just below it and start to fall down. So this looks like a very clean as of right now on a 3-day chart. Let's look at this on a daily. Very, very nice looking. Look at this. Very nice looking pattern here for a 3-wave top. And you have some resistance. And within this pattern, it looks like you're forming a smaller double top. Right here, a smaller 3-wave pattern. So something else you want to watch if you see the U.S. market start rolling over. And the key indicator of that's going to be what? It's going to be these big tech earnings on deck today. So watch that. Jump over to the CAC. 7712 was almost wicked. Look at that. 7712. The key resistance was 75.75. You got back above it, wicked it. Now you're at 76.01. Same type of pattern here as the DAX. We went over this previously. I'm not going to do it again. On top of your Wyckoff, big Livermore pivot, lots of resistance here. Watch these 2 levels, 77.12, 75.75. Start falling below that with the U.S. market selling off. Then you know the drill, guys. These markets will track to the U.S. markets. So look at Microsoft putting in a topping pattern. Microsoft, it had beats. All these stocks had beats, but you got to remember this is on lowered expectations. It's part of the game that they play. They ratchet down the expectations. So when they beat, they can say everybody beat. The beat rate's almost always the same. Whether it's a good year or a bad year, it's always whatever it is, 75, 80% beat because they lower it. So when you look at Microsoft, it had its beats. And this is starting to form a topping pattern. You had your big sell-off. Now you're rebounding. Now you're getting supply dumped back on you. So watch Microsoft here because when Microsoft comes down, you're going to have to take out this higher level zone here that you've been accumulating at or were accumulating at. But you're looking at Microsoft pulling back down to the 618 at 382. It's at 403. And then obviously if it starts breaking down below this pivot area where you formed your Wyckoff accumulation, you're looking at Microsoft down here at 330. So we'll see because some of these companies have so much money flowing into them and so much FOMO, you're not going to see them move as much, which is why I prefer the indices versus individual stocks. But these are good to track. NVIDIA putting in a topping pattern as well. As you can see, lots of dojis, lots of supply wicks. Your top range here is 639. You're staying above your 613 support. You're at 625. Their earnings are not out yet. They come out later this month. When is that? February, is that 24th? Let's click that. February 21st. So February 21st, you still have some time, but you'll see this with some volatility when the markets start moving. So look at AMD. Man, we didn't make it to 197. AMD. So you had your sell-off, 3-day chart here. Let's look at this. It's holding up well, better than it should, but it's holding up well. There's your move down. You need your move back up. Watch the 181 range. That's what I'd be watching, 181. Let's see what happens with timing-wise with the U.S. markets. Looking at the 180 for 786, 618 is at 176. So I would watch that range just rebound back up. I would only trade, this is just me, again, not financial advice. I only trade individual equities based on what the broader market's doing. What are the indices doing, right? So that's what I like to see. So if they start breaking down and this is holding up, then this might be something I jump on at a later stage. Gold's still holding up. Gold's actually pushing up nicely, 2054. This is just such a big resistance range, 2069. We've been over that many times. Had a big short on this multiple times here in the market. These big drops, 250 bar drop. So gold, I anticipate retracing with the markets in this correction phase. So I'm looking at gold either going to 2019 at a very shallow level, which is already done, or 1979 or 1939 would be my 3 levels here to watch for gold when the markets start to retrace here more in February. All right, guys, hope you enjoyed the video. A little bit of a long one. I hope everybody has a fun, safe, happy weekend. I'll see all you guys Monday. Please do like and subscribe. We're on X as well if you care to give us a follow there, and you can watch these videos on X as well. All right, guys, take care. Talk soon.